Hello, everyone. Welcome to our webinar. Today, we are thrilled to welcome insight provider Michael Howell to discuss the state of global liquidity in 2021. As a companion to this webinar, I would urge everyone to check out Michael's insights, Global Liquidity 2021, a warning, and its adjacent insights as they paint quite the picture on the topic. Welcome, Michael, to the webinar. Thank you very much for being here.
Good, thank you.
Michael is managing director at Cross-Border Capital. It's an investment advisory firm specializing in micro-investing. Founded in 1996 with an international client base, Cross-Border focuses on monitoring and understanding global liquidity and capital flows. Michael, without further ado, we can kick it off. I especially liked your closing in your recent insight that strong economies rarely enjoy strong financial markets, which has given us quite the thing to talk about around Smartkarma.
Good, Mike. Thank you very much. Welcome, everybody. Let me first say a couple of words about what liquidity is, why we look at it, and why it's relevant for asset allocation. In terms of the size of the global liquidity market, you can see on this slide the relevance of global liquidity, both as a share of world GDP, which is on the left-hand graph, showing it's almost double world GDP, or certainly will be this year. And then the track of how global liquidity has moved on the right-hand side as in terms of trillions of US dollars, with the red line on that right-hand graph showing what central banks have done on the right scale. Now, global liquidity is a pool of cash, a footloose pool of cash that's almost 180 trillion US dollars. It's global. That means that cross-border flows are very important. You can't simply take a national view now. Money is fungible. It moves around across borders. And secondly, it's not money supply as people traditionally define it. Money supply is a very archaic concept now. It was relevant when banks were dominant. Banks are no longer dominant. Non-bank financial entities are now major suppliers of credit through repo markets and via collateral. So the reason we emphasize liquidity is that liquidity embraces all these various credit providers globally. Hence, that's what we track. The origins of the approach go back to when I was at Salomon Brothers back in the 1980s. Salomon Brothers were then the world's biggest investment bank trading operation. And the philosophy of the firm was to understand how to make money in financial markets. You need to watch money flows. And we put a lot of emphasis on tracking money flows worldwide, and particularly in the wake of the 1985 Plaza Accord, when capital began to wing around the world at very rapid speeds. We needed a concept, and we came up with the idea of global liquidity. So the origins go back to the late 1980s, and they come out of Salomon Brothers. And ever since that date, we've been tracking these flows. We have an unprecedented database covering 80 countries, which we've kept up in real time since that point. Now, why is liquidity important? Let me show you this graph here, which is an index of the previous data. It's shown as an index so the cycles become more prominent. And what this is illustrating is how liquidity has moved on a month-by-month basis in this index since the mid-1960s. The index is a normalized data series based on the growth of liquidity, in fact, the growth of excess liquidity relative to the size of economies, with an index scaled from 0 to 100. This is the global aggregate. There are annotations put on that diagram which illustrate various pressure points. It very broadly says high liquidity is associated with asset market booms, and banking crises tend to be associated with periods when you get very tight liquidity and you consequently face refinancing crises. The flow on the bottom, the arrows, illustrate the timeline of how liquidity moves through various asset markets. It begins to affect fixed income and forex markets after about 3 to 6 months. Then it moves to equity markets, and then it starts to infect real economies about a year to 18 months after the initial surge of liquidity. In terms of the risks, this slide here is illustrating why monitoring liquidity is very important from a financial stability standpoint, because liquidity is very much associated with debt. Now, what we try and explain here is that complex interaction. And very broadly, the whole point about the financial systems today in many Western economies is they are no longer new financing systems. They are refinancing systems. And if you're refinancing debt, you need balance sheet, you need liquidity space, and therefore liquidity is critical to roll over debt. But the paradox in this equation is that liquidity itself depends on debt because safe assets provide collateral against which liquidity is often lent or created. And therefore you see this complex interaction where, as we say, each turn of the debt liquidity spiral tends to ratchet down credit quality as safe assets become riskier. In other words, more safe assets or so-called safe assets are used for collateral. And that's why we got the 2008 financial crisis. That's why you saw the jitters in financial markets in 2019. That's why the beginnings of the COVID crisis were so awkward, because it's all about this nexus between debt, liquidity, and refinancing. Now, liquidity is critical in terms of economies and how economies move. And what we illustrate here is on the left-hand graph, world business confidence in yellow and our global liquidity index that we just looked at as the red line put on top of that graph, but actually advanced forward by 9 months. So liquidity is a leading indicator. And you can see there the power of liquidity in driving economies. And if there is any question about whether business confidence is going up or going down, we put a companion graph on the right-hand side, which shows world shipping activity, which is basically container volumes and transportation metrics, which basically illustrate that the world economy has enjoyed this V more or less as the liquidity data has predicted. And liquidity being high virtually ensures that the world economy will recover very fast from this COVID crisis once the lockdowns end. But it's not simply a question of looking at economies. It's also a question of looking at asset markets. And this graph in front of you now is looking at the growth rate, the simple growth rate in dollar terms of our global liquidity aggregate, charted alongside the increases or decreases in the value of world wealth. Now, world wealth consists of all financial assets across the 80-country database that we cover. In other words, bonds, equities, liquid asset products. It also includes housing, where we've taken data from the BIS Global Residential Housing Database, and precious metals. So what this basically shows is a world wealth aggregate that in financial terms is $250 trillion. Adding in the residential real estate, it probably at least doubles or even triples that amount. So we're looking at a large pool of cash or investments, and global liquidity, as you can see, is driving that. Now, as Michael outlined at the beginning, one of our watchwords is strong economies don't have strong financial markets. And one of the risks in looking at liquidity is not just simply that central banks will tighten, but it's also the fact that strong economies themselves will absorb liquidity from financial markets and cause inflections in asset markets. And that's what we think is likely to happen in 2021. The surge of GDP will likely cause liquidity conditions to inflect. And the projection that you see in the brown line, the dotted part of that, is our predictions of what we think is likely to happen. And therefore, we're somewhat close probably to a peak in asset markets. They will probably have continuing strong Q1, but we think there are danger points coming in Q2, Q3 this year. Let me say something about the size of this liquidity pool and what's important. And I think that's a very good precursor to coming on to what China is doing, because China is very misunderstood, but it plays a very, very big role in understanding global liquidity. The pie charts basically illustrate sources of liquidity in 2020 on the left and projections 2021 on the right, with central bank provision shown on the top two pies and total liquidity shown at the bottom. Central bank provision is about 30 trillion out of that 175 total pool. So it's eclipsed by the private sector, but it's still an important source. What you can see are two takeaways that we've illustrated here. One is that in terms of the supply of central bank liquidity, or QE in 2020, China played what seems to be a very small role, providing only 1% of total central bank liquidity. However, China provided 20% of the overall increase in global liquidity. And that's because the PBOC, the People's Bank, doesn't only operate through its balance sheet, it operates via lending directives. And there were clear lending directives given to state-owned banks last year, which basically meant that you saw something like a 20% contribution of Chinese money to global liquidity in 2020. A similar feature is likely to occur in 2021. China is playing a bigger role. The People's Bank is beginning to ease, contrary to what many commentators argue. Our detailed analysis shows that is underway. And I think the uplift in the Chinese markets and Chinese economic activity attests to our view. China is important in the equation and it is easing. What's more, other emerging markets, which contributed virtually nothing in 2020 to global liquidity, are beginning to play a bigger role, largely because the dollar is weakening and central banks in these economies, particularly across Asia, are beginning to monetize those capital inflows. This heat map illustrates how central bank liquidity is changing. And you can see from the heat map that there was a distinct change in color or temperature in terms of central bank activity beginning around the COVID crisis in March, April of 2020. The only central bank that was persisting with a tighter policy was China's People's Bank, as you can see in the middle of that graph. But latterly, China has begun to ease, and now all central banks are virtually in the green phase. Why is China easing, or how is China easing? Let me just illustrate what is going on very briefly here. First of all, you can see on the left-hand graph, two lines, total liquidity growth in the Chinese economy, which is the red line, and monetary base growth, which is shown as the yellow line. Since August of last year, there's been a significant uplift in Chinese central bank activity. One of the things that you need to do in looking at the data is to be very rigorous about seasonal adjustment, because there are huge seasonal patterns in Chinese liquidity flow, given the fact that it's still predominantly, or to a very large part, dominated by a rural economy and agricultural demand for credit. Also, you've got the floating Lunar New Year holiday, which distorts a lot of monetary flows. The chart that's on the right shows seasonally adjusted rolling 6-month liquidity injections by the People's Bank. And you can see there is a very clear uplift underway right now after what has been a dearth of liquidity for 2 or 3 years, which has held back Chinese markets and the Chinese economy. Question which is often posed to us is this a bubble? We say absolutely not. There are two ways to monitor this. One is to look at the left-hand graph, which looks at the total value of all equity holdings worldwide, divided by the total pool of safe assets. And safe assets are defined as G10 government bonds plus central bank liquidity of all central banks worldwide. That ratio is elevated, but it's not at previous bubble levels, which have exceeded 1 times. And the projection to the end of 2021, given fiscal issuance, debt issuance, and central bank commitments to expand balance sheets, takes us to where that dot is. And then probably in a more straightforward or simplistic ratio, which is the ratio of total equity holdings to all global liquidity on the right-hand chart, shows that there's no evidence of bubbles in the data at all. And you can see that we are well below previous bubble heights. So it seems from our perspective that there is no bubble in markets at the moment. There are clearly areas which are extended and there are clearly speculative areas, but generally markets seem, we think, to be fairly well positioned. Does this methodology work as a way of making money? We are very rigorous about showing our data and our research works as a tool for investment managers. What you can see are 2 backtests, which basically show how liquidity has actually driven markets. The bars refer to positionings of those 2 previous indicators, particularly the right-hand side one, the equity to liquid asset ratio, of when it is 2 standard deviations above normal, or 2 standard deviations, or 1 standard deviation above normal or below normal. That shows the subsequent 2-year ahead returns from developed market investment and from emerging market investment. The clear takeaway is
that if you buy equity markets when the equity holdings to liquid asset ratio is 2 standard deviations or more below normal, what you find is you get a 2-year ahead return of over 30%. That applies both to emerging and to developed markets. So the methodology works very clearly as a way to make money in markets. Let me finish on one final thought, which is what's happening in the dollar markets. And this chart in front of you basically shows what is going on with capital flows. One of the things we put great emphasis on is looking at the flow of capital around the world and how that influences global liquidity movements. What you can see in front of you is a chart that shows 3 capital flow series, one in red going into Europe, one in yellow, which is the Asian flows, and one in brown, which is the American flows. They're shown as a percentage of global liquidity. A positive number means that that region is seeing capital inflows. And you can see that there have been, largely speaking, 3 periods of strong capital inflow into the US dollar. One in the mid-1980s, as I indicated, this was post-Plaza Accord, which was the genesis for our global liquidity work. That was when Japanese insurance companies were buying US treasuries significantly, and hence the pickup in the brown line is offset by a collapse in the yellow line as capital left Japan. Then you see in the late 1990s, the Asian crisis, when safe assets fled into the US, the safe haven of US dollar treasuries. And again, the spike in the brown line coincides with a collapse in the yellow line. And then you see more recently, the period from 2015 through 2018, when there's another spike in dollar inflows, which coincide with capital outflows from China principally, with Xi Jinping's corruption clampdown, which caused money to fly into the dollar. And also alongside, you'll see the red line is very depressed because capital left the Eurozone because of the Eurozone banking crisis in 2012. That was another source of capital outflow. Spike in the dollar reinforced by Basel III demands for safe assets, where people went into US treasuries. And you can see that spike has now ended and it's coming down. It's still elevated, it's above zero, but it's coming downwards. And we would suspect that what you're likely to see is the influence of a weaker dollar occurring over the next few years. We think the dollar is in a 5 to 7 year bear market, which will be something which helps global liquidity because it's very important in the global liquidity sphere for the dollar to be weak. It encourages borrowing in dollar terms. So let me finish at this point and see what questions there are. And Michael can also maybe add in any other questions that come across. There is a question I can see, which I can read out, which says, you're bearish for the US dollar for the next 7 to 10 years. What do you think of the argument that dollar fall can only be temporary because of the constant demand coming from the euro dollar markets? Now, it's a very good point, and let me address that in a couple of ways. One is that the euro dollar markets are being squeezed significantly. They're still very important, but there have been a lot of attempts by the US authorities to rein in the euro dollar markets. And that is through a combination of tax treatment, where there was a tax amnesty on US corporations, which encouraged them to pull money back into the US. And as well, you could also argue the swap lines, which have been used with some alacrity this year, are trying to, if you like, get around private provision of dollars. So the Federal Reserve is trying to wrestle control back. So I think that's point number one. Point number two is that there is likely to be big supply of dollars in the markets, net, let's say, because of two things. One is that a lot of the Basel III demands for safe assets, which were a step up for bank balance sheets, have been fulfilled, and therefore the incremental demand for dollars won't be there as they were in the immediate wake of the global financial crisis. Alongside, issuance of safe assets elsewhere is stepping up significantly. For example, the euro dollar issuance, in other words, the euro bond issuance, I should say, by the European governments, the pan-euro bond, which is destined for this year sometime. That is significant, another $1 trillion of issuance. And you've got the fact that the US itself is likely to be doing a lot of issuance, and that will likely weigh on the dollar. One of the things that's very, very important to bear in mind is history. If you look back to the history of the international monetary system, particularly in the wake of World War I in the late 1910s to 1920s, you'll see there what happened when sterling declined, or more particularly, I should say, sterling lending declined, and the US stepped into the breach. The transfer between sterling holdings and dollar holdings happened in a matter of 2 or 3 years. It was quite phenomenal to look at the data. It's not impossible for China to do the same. And one of the things that you see Western commentators doing is dismissing the opportunity of China. Don't do that for the simple reason that all China needs to do is to redenominate trade more in yuan and develop a trade credit market. And bang, the yuan becomes a much, much more important global currency. Second question is, due to ever increasing debt, do you see a solvency crisis in the next 10 years, resulting in huge counterparty risk and also physical gold and Bitcoin? Is that the place to be? The answer to that question is that in all the years I've been in financial markets, I've very rarely seen solvency crises, but I've seen an awful lot of liquidity crises. And that's what you tend to find. Central banks tend to come in, or governments tend to come in, and what they do is they provide liquidity. In the environment where they have to provide liquidity, and I think they will have to, because the big problem with debt is not so much whether it defaults, it's whether it can be rolled over. And rolling over debt requires liquidity. So there'll be a lot of liquidity pumped in. On that basis, physical gold looks good. Yes, definitely. We think that gold is heading towards $2,500 an ounce. And Bitcoin also, yes, because it goes up. And one of the things that you will see in the data, and it's slightly exceeded it in the last couple of months, but the Bitcoin gold ratio is around about 6 times. And that's something we've been using as a guide for the last 2 or 3 years. And therefore, we've been very much arguing that Bitcoin jumps. Our prediction for Bitcoin was 25,000. It's easily exceeded that. But given where gold is likely to go, that's probably not a bad benchmark. Another question is, there's been a huge inflow into US tech stocks in the last few years. If a likely collapse happens, with a backup in treasury yields on issuance, will there be risk off, and will that cause redemption flows back to the dollar? Elevated central bank liquidity has already caused dangerous overvaluation in US equity markets. Is that likely to end badly and be bullish for the dollar? I think the answer is one that I would question whether there is dangerous overvaluation in US equity markets. There's a piece we wrote on Smartkarma which argued against that. It's saying that what you've got is you haven't got such overvaluation right now as many people would argue. I think the big risk, however, is to markets is that the flow of liquidity is interrupted. And that flow of liquidity could be interrupted quite easily because of dislocations in the debt markets or strong economies or whatever. But it could come back to the fact that inflation starts to rear its ugly head. We think inflation is likely to pick up to about 4 to 5% this year in the US, not disastrous, but clearly an issue. And it's that which causes the big problem. If bond yields start to go up, this whole debt liquidity nexus or spiral is threatened. And that's when central banks have to become a lot more alert. Now, the real question is, do people go back to the US dollar in that environment? Well, we know that dollar financing is potentially flaky, or do they look elsewhere? And I think they start to look elsewhere this time. And that's why I think that China is playing its cards very cleverly at the moment. I think that the yuan will get something of an uplift during any sell-off. But I think in particular that gold and Bitcoin, as we've already seen, will be winners. Next question is a weak dollar positive for the gold price? Yes, it is. But gold is primarily a liquidity phenomenon. One of the things that you see if you look at the data is that rather paradoxically, gold is not necessarily an inflation hedge. It's a liquidity hedge. So in other words, if you see lots of liquidity going in, gold will go up. And as I said, our view is 2,500. How does a more active fiscal stance by governments globally, particularly the US, financed by some form of MMT, affect global liquidity, if at all? It simply adds to it. Basically, what you've got to think about is a money multiplier where total liquidity rests on a monetary base And that monetary base includes both central bank balance sheets, cross-border pools of dollars or foreign currency, and collateral. And part of that collateral is basically money that comes from debt issuance. So in actual fact, what you can find is that if central banks add liquidity through QE, that can expand global liquidity. Or equally, you could argue, if governments issue lots of high quality, pristine collateral in the form of US treasuries or German bonds, that's another way of actually increasing liquidity, because that can be borrowed against. 2020's fall in oil prices was said to have released liquidity to the world markets, however, prices have since climbed above dollars a barrel. Is that a drain on liquidity? Yes, it is. Similarly, asset prices in real estate and other stores of wealth have bounced higher, which I interpret to be a drain on liquidity. Do you see these drains on liquidity a potential risk to the bull market? Yes, I do. I think that's a problem. That's one of the reasons that we said right at the beginning that strong economies do not have strong financial markets. And that's the thing to watch. It's not that central banks will tighten necessarily, although I think that day is nearer than people think. It's much more that strong economies will absorb liquidity, and it could be strong real estate markets absorb liquidity. Hence the threatened directives in Singapore on containing real estate price increases. Does the liquidity model essentially set at odds with the notion of Buffett's intrinsic value in stocks? Very, very good point, philosophical point, but it's a good one. And if you go back to the article that we wrote on Smartkarma about a week or 10 days ago, you'll see there that we run through a model which questions whether you should be using intrinsic value models that are useful for stock investing at the macro level. And our view is that they're two very different factors. The macro level, you've got to use macro valuation tools and look for macro valuation shifts. And that's about looking at investor sentiment and looking at liquidity. I have never seen PE multiples work as an asset allocation tool at the market level. I'm willing to be proved wrong, and anyone can prove that, but I've so far never seen that to be a useful guide. For example, European markets always have lower PEs than the US, but they don't always outperform. In fact, very rarely they outperform. Look at Japan through the 1980s, very high PEs, but it basically outperformed the US, and Japan has had low PEs for 20 years and it still hasn't outperformed. So PE is not the answer. Given huge government interventions, will Fed implement yield control? Do you see further financial repression via regulators forcing banks to lend at maximum spreads that do not surpass inflation levels? Yes, I think the latter definitely. I think we're in a financial repression era, and that's what central banks and governments will want to do. So they want to keep real interest rates negative for as long as they can. Will the Fed implement yield curve control is a more specific question. And I do not think they will, because I don't think they have the ability to do that. Part of the reason I say that is that if you go back to the previous period of yield curve control in the US, or in a more recent example of Japan or Australia, the central banks or the authorities in all three examples had very good control of the bond market because the banks were big owners and they themselves were big owners, the central banks. In the case of the Fed now, 40% of the bond market is owned by foreigners. So I think it's really difficult for them to implement yield curve control. The best they can do is to essentially use forward guidance and keep their fingers crossed. And that's what I think they're going to try and do more and more of. So that would be my answer. In fact, if you ask FOMC members privately, are they enacting yield curve control? They say they're not. That's not on their agenda. China's trade surplus for the US has bounced back to high levels last year. It's stayed high since its entry into the WTO. However, foreign reserves have ceased to increase. Considering the impossible trilemma, do they have a secret stash of US dollars somewhere? Very good point. The question is, no, they don't necessarily. The point is that they don't want to accumulate dollars because there is clearly the long-term policy of getting off the dollar hook. What China needs to do is start exporting yuan and not re-exporting dollars. And therefore, what they do not need to do is to build up their foreign exchange reserves of dollars. Hence, what they're doing is encouraging foreign investment. And what you will see is more and more evidence of China diversifying either into other currencies, for example, looking at the euro, potentially doing things like the Belt and Road Initiative on bigger scale in the next few years, and also using monetary policy directly to weaken the yuan. And one of the things that I think is going on, and I may be proved wrong, but if you look at what's going on across the Asian region, there is deliberate currency management going on. I think what is happening is that there is a sort of a quasi-euro type engagement there where currencies are being fixed against one another. I've never seen such low currency vol in the system. Any signs of stress you are seeing in the Eurozone bank debt markets, and are you expecting to see this as we saw after the GFC, given how weak banks and sovereigns were before EU economies went into lockdown? I think the answer is that we will see another crisis. I don't think we're seeing one yet because I think that there are not so many strains in the private sector right now. I think governments or central banks are on top of that. I think the biggest risk to markets in the next 6 months is a too strong world economy. But let's not rule out another episode where credit providers run into trouble. The problem is, as I've outlined, is there's been this sort of debt liquidity nexus or spiral which has been going on. And every ratchet up in the debt liquidity spiral increases credit risk. And that's something that central banks need to be alert to. That risk, I don't think, is paramount at the moment, but I think it may come back. Next question is that you said liquidity crises likely rather than solvency crisis. What if people lose trust in fiat currencies? Won't it turn into solvency or other types of crisis? I think the answer is that it could do, but I think that, let's not sort of underestimate the power of central banks and governments to print money aggressively and try and resolve those problems. If you look at the history of the 1930s, which is always a salutary lesson to do, you'll see the volatility in currency was unbelievable. And plain fact was that the French franc in the 1930s was the strongest currency in the world until it suddenly became the weakest currency in the world. So things can change overnight. And, I think there are questions about solvency out there, but I think we've got to remember that the first response of governments will be to print money to try and alleviate those problems. So I think the liquidity crises come first. And as I've said, certainly in my experience, you see a lot more liquidity crises and solvency crises. But I think you've got to start to look more widely about diversifying assets because currency is the first stage in any asset allocation. Correct choice of currency. I'd be diversifying now out of the dollar. What's the biggest threat, in your opinion, to US government bonds or the world's most sought after safe asset? I think the fact is, look, the most important price in the world economy is the price of the dominant economy's debt. In other words, the US Treasury market. What's the risk to that? The risk is that the US fiscal balance runs out of control, given the entitlement, the size of the entitlement program, and the fact that that entitlement program may be egged up by Biden, the Democrats, is clearly a risk. And then on top of that, you may get embedded inflation starting to pick up in the US. And those two factors by themselves will undermine the dollar. If you go back to the late 1970s, when the dollar was clearly in decline, the Carter dollar was a very weak currency, and people lost confidence in the US, that was when inflation and the fiscal balances were running out of control, and it required Volcker to come in and be really, really tough in terms of hiking interest rates and squeezing inflation for the dollar to actually recover. Most of the periods of dollar strength in the last 30 to 40 years have basically been periods where the US authorities have, let's say, kind of artificially, although I put that word in inverted commas, created demand for dollars through either financial crises or regulation. Otherwise, the dollar has been in a long-term downtrend. And there's a book I wrote a year or so ago called Capital Wars, which addresses the reasons for why that was. But it's largely because of the US, because of the power of the US financial system and the fact that US banks essentially want to create credit. Another question is, considering a wall of US dollar debt coming due from developing nations that are still struggling to recover from COVID, do you see a US dollar squeeze considering shorting dollar is the most crowded trade out there? I think there are two things I'd say about that. I mean, one is that clearly is a risk, but I don't think it's the paramount risk that's going on right now, because I think the IMF, the World Bank, and the US authorities will be providing sufficient dollars to do that, to roll those debts over. It's really a rollover question. I think the other thing is about which is implicit in that question, is What about the shorting of the dollar and looking at some of the CITC data on short positions in the US currency? Yes, I'm aware of that. It's never been a very good predictor of the dollar, to be truthful. It's an interesting point to ponder, but its track record is poor. What you really need to look at is data like the one that you're looking at in the chart I show you, which is looking at the long-term capital flows into the dollar and explaining those spikes and why they may be coming off. Another question is, M2 continues to stay around historic lows. So does your argument for a strong economic growth post-lockdown solve this, e.g. M2 pickups, or is policy change, is more helicopter money approaching? Well, I would question whether M2 growth is actually so low. I would say it's actually quite high, and more particularly M1 growth is growing at very, very high rates. If you look at M2 expansion in the US, what you find is that it's actually about 8 times the increase that we saw after the GFC in 2008-9. So I think it is underway, but your point is well taken that it's not all about M2. You've got to look at the much broader measures of liquidity, as we stressed right at the beginning. It's also looking at non-banks provision of liquidity, which is really what you call wholesale money, because that's more and more important as the world gets bigger, so to speak. So I think that there is more liquidity coming, and I think central banks will have to be ever alert to this. And, we can see the alacrity with which they inject liquidity during periods of wobbles in markets anyway, and that's going to persist. If the dollar is going to fall for the next 5 to 7 years, can we assume rolling of EM debt won't be a problem in that period? Well, yes-ish. I think that's a fair point. I think there's going to be more dollars in circulation. I think that you've got to look at the supply-demand balance for dollars. And the basic fact is, I think that first of all, you've got an increase in supply for the reasons I said, coming both fiscally and from what the Federal Reserve is doing. You've got big demands which were there from European banks as well as US banks and probably some Asian banks for dollar-safe assets. And you've got to remember that occurred during a period where Basel III was enacted and when the supply of bunds from Germany actually went negative. So there was no new supply of bunds. In actual fact, bund supply contracted. So the US Treasury were the only game in town. And you also had demands for dollar liquidity from China for various reasons. One was the anti-corruption drive, which caused a lot of capital to flee China into the dollar. Those factors are no longer around, and therefore dollar supply is going to be there without those challenges. And therefore, I think there's more room for emerging market debt to be rolled over. Yes, I do. Won't be a problem, I don't think. I think debt is a problem generally. I'm not going to deny that, but I don't think the specifics of EM debt or EM dollar debt are as pronounced as people say. Liquidity to equity looks in a normal range, so you suggest little evidence of a bubble. But how do you think of this in terms of regional differences in equity markets? Could the US be in a bubble, but others not? The answer is a very good question. We do this for lots of different countries. The US is more elevated than most, but the US is still not at that bubble level. One of the things to remember, and I'm not sure if we do this on our research, but I don't know if I've written about it on Smartkarma, is that if you look at the extent to which the US market sold off in March, April of last year, and that was unprecedented. In terms of those metrics that we looked at earlier, which is the equity to liquidity ratio, if you look at where the US got to, the US ratio fell at such speed and to such scale that the US moved to, I think it was almost 4 standard deviations below normal. It became the most oversold market on that basis of any market worldwide. And one of our clients, Fidelity in the US, told us the remarkable statistic that in the middle of April, something like 30% of all their account holders had sold every equity they owned, which is an absolutely eye-watering statement. I mean, it's incredible. But that's why the US market has bounced back. So the US market has moved into extended territory, but it's not really in what we've previously seen as bubble territory. It's more extended than most other markets. If you look at China, for example, China has a lot of scope. Back in 2007, at the height of the bubble economy, sort of the bubble that was occurring in markets, the ratio between Chinese equity holdings and total liquidity got to 1 times. Currently, it's about 0.2, just over that. So there's a huge amount of scope for China to rebuild, and the trend line is upwards in terms of what's going on. Asian markets look more extended than most, I'm going to have to say. Thailand and Singapore are the exception. Korea looks very extended right now on those ratios. European markets, a bit less so. The UK is the cheapest market by far in the world, but so are commodity markets using these same metrics. Look at things like Canada, Australia, some of the South Africa, some of the big commodity markets. They're the things that are going to really benefit, because if we're correct and you see strong economies coming out of this, commodity markets are going to be very, very strong. So let me stop there and see if there are.
Thank you very much, Michael. And thank you very much for actually making my job a lot easier by reading out the questions yourself.
All right.
And thank you, everyone, for the great questions. There's actually one more question that came in through the chat, and that's, what do you make of the PBOC unexpected liquidity drain today?
I don't think it's an unexpected liquidity drain. One of the things that you've got, that this is a really difficult period, the period from early January through to early February, because of the Lunar New Year holiday. It's very, very difficult to get a gauge on what's happening accurately with the PBOC, which is why we use seasonally adjusted data, and we tend to look at rolling trends over several weeks or months. And what you've got at the moment in Chinese money markets is a very gradual build-up, but a progressive build-up in liquidity, as that earlier chart I highlighted basically showed. And I maybe can just briefly go back to that, which is this chart here. What you can see in this chart is China PBOC liquidity injections on the right, and that's looking at a rolling 6 months. There was a liquidity drain, if I remember correctly, on Friday as well. There was nothing on the Saturday data or on the Monday data, and I wouldn't hold up much from one day's movements. But clearly, if it's a trend, it's a trend. But looking at this, we think that China is expanding again. What is driving that is basically the yuan. Periods when the yuan is strong tend to coincide with periods when the PBOC injects more liquidity into markets. And the PBOC's policy over the last 18 months or more has basically shown me that they are interested in managing the currency, because everything they do, such as changing reserve requirements for regional banks, is what they typically do during periods where they're focusing on exchange rate management. And I think this is the key thing that markets globally are missing, is the extent to which China is putting the yuan as a policy priority now. They want yuan stability. And, if you want two sort of takeaways to look at the Chinese real exchange rate against other Asian peer currencies. It's remarkably stable. I mean, this is being managed. And then look at Asian currencies en masse as a trade-weighted index. And you'll see there's virtually no movement of any Asian currencies, even the yen. I've never seen currencies in Asia this stable.
Right. Well, thank you once again, everybody, for the great questions. And thank you, Michael, for taking them in stride. And of course, for your very thoughtful presentation. If you would like to engage Michael directly, please contact your Smartkarma account manager, and they will be able to assist with that. And you can always contact us at research@smartkarma.com if you have any other question. Michael, let me thank you very much once again.
Good pleasure. Thank you, everybody, for listening.